The era of cheap, easily accessible global energy is on an indefinite pause. This immediate tightening stems directly from the de facto blockade of the Strait of Hormuz, compounded by recent, highly targeted attacks on Middle Eastern energy infrastructure. By the numbers, we are currently analyzing the largest single supply disruption in the history of the global energy market. Looking at the geographical fallout, global crude supply plummeted by 10.1 million barrels per day in March alone. That is roughly 10% of total global output, vanishing in a matter of weeks. Many in the market are still pricing in a rapid diplomatic resolution, assuming a seamless return to the pre-war status quo. The data tells a different story. To understand where prices are heading, we need to dissect the deteriorating supply and demand dynamics and look at how the futures curve is violently repricing right now. This intelligence is specifically synthesized for C-level executives and capital allocators who need to position their portfolios for a sustained period of high energy costs. By the end of this analysis, we will map out a strict three-pillar strategic playbook for the quarters ahead. For corporate treasuries, adopting a wait-and-see approach is mathematically unviable. Aggressive risk mitigation is now the only path forward. International energy organizations have just released their highly anticipated global crude supply forecasts for April, and the macroeconomic picture is rapidly deteriorating. This comparative data table shows the International Energy Agency making an aggressively bearish pivot. They have slashed their 2026 supply forecast by a massive 1.50 million barrels per day. Concurrently, the IEA revised its demand forecast downward by 80,000 barrels per day, the first demand decline since the 2020 COVID shock. The agency explicitly attributes this to price-induced demand destruction. Soaring costs are choking the global economy. The U.S. Energy Information Administration confirms this trajectory, slashing their own global supply outlook by an even steeper 2.03 million barrels per day. While the EIA still models a slight demand growth, this massive supply cut creates a projected structural deficit of 290,000 barrels per day. In stark contrast to the consensus modeling of the IEA and EIA, OPEC stands as a complete outlier. OPEC is holding the line on its previous forecasts, still projecting a highly optimistic 1.38 million barrel per day increase in demand. When forecasting models diverge this severely, prudent capital allocators must prepare their balance sheets for the most severe scenario, a prolonged structural deficit. The market briefly exhaled during the April peace talks, pricing in a degree of diplomatic optimism. However, conditions on the ground confirm the U.S. Iran ceasefire is actively failing. Consider recent escalations: the U.S. naval blockade on April 13th, weekend skirmishes with commercial vessels, and the seizure of the tanker Tuska. These events strongly indicate the current truce will expire without securing a permanent transit agreement. Furthermore, diplomacy cannot instantly repair infrastructure. Even if the Strait of Hormuz fully reopens tomorrow, severe physical damage to key facilities is already locked in. The IEA has explicitly warned that restoring damaged Middle Eastern energy facilities to their pre-conflict output levels could take up to 2 full years. We also have to account for the latency of the supply shock. Physical supply chains move at a fraction of the speed of financial markets. The last physical tankers to successfully pass through Hormuz before the conflict erupted are reaching their destination refineries right now. Once those final holds are emptied, the physical market tightness will stop being a latent threat and become a highly visible, acute shortage. As the reality of the failing truce sets in, financial markets are violently repricing the cost of energy. We've watched spot prices surge over the past week, with WTI pushing toward $88 a barrel and Brent crude breaking above $96. This coordinate plane plots crude futures over time. Notice the sharp downward slope of the curve. In commodity markets, this condition is known as steep backwardation. It is a flashing red signal indicating severe, immediate physical shortages, where buyers pay massive premiums for oil delivered today rather than next month. Institutional expectations of prolonged pain are deeply embedded in forward pricing, particularly in the one-year WTI contract. At the end of February, that contract sat at $62.77. Last week, it surged to $74.11. Unless a permanent Hormuz transit agreement is signed this week, this trajectory will hold. Without that agreement, the market will cement a permanent geopolitical risk premium of $15 to $25 per barrel through the fourth quarter of 2026. For CFOs and institutional allocators, passive treasury management is no longer an option. Here is the operational response. The first pillar of our playbook is corporate hedging. Implied volatility in energy derivatives is soaring across the board. Heavy industrial, manufacturing, and transport-reliant balance sheets must aggressively execute call options or fixed-price swaps to lock in fuel costs for quarters 3 and 4. The mandate here is simple. Do not leave your operational margins exposed to the volatility of the spot market in a structural deficit. For institutional portfolios, the second pillar is asset allocation, specifically targeting geographic security. Allocators should heavily overweight upstream exploration and production equities that carry zero Middle East exposure. The prime targets are U.S. shale, offshore Atlantic, and Latin American producers. As the blockade persists, these secure, non-conflict barrels will command massive geographic premiums, making them the most coveted assets in the global energy trade. The third pillar of the playbook, macroeconomic ripple effects. Sustained crude above $90 a barrel will inevitably bleed into economic metrics, triggering a secondary inflationary wave. Because of this inflation pressure, central bank rate cuts anticipated for 2026 are in severe jeopardy. CFOs must immediately pivot their fixed income portfolios to account for stalled rate cuts and a higher-for-longer monetary environment. Every corporate capital structure must be stress-tested today against a sustained high-interest rate regime. The data is on the table. The supply shock is real. How is your treasury team stress testing for $95 Brent crude, and are you adjusting your hedging ratios? Let's discuss your allocation strategies in the comments below.